Welcome to Casa Academy Chapter 12, Part 2, where we will cover residential mortgages. All right, let's just dive right into this, shall we? Today, we are looking at the absolute foundation of real estate financing. You know, when you sit down at the closing table, there is this massive stack of paperwork, but there is really a dynamic duo of vital documents that makes the entire world of residential lending possible. We're going to break these two documents down so you understand exactly how they work together to protect both the buyer and the lender. Here is our roadmap for today's explainer. We're covering the promissory note, the lender's risk, the mortgage itself, hypothecation and concepts, and wrapping up with a quick exam summary. This is really the dynamic duo of financing, so let's get your notes structured perfectly for that licensing exam. Section 1. The promissory note. Legal evidence of the debt. So let's establish exactly what is happening when a buyer actually borrows money to purchase property, particularly in a lien theory state like Florida. Well, it starts with the promissory note, or honestly what most people in the biz just call the note. Think of this as your formal, legally binding IOU. When the lender hands over the funds for a real estate purchase, the borrower is required to sign this contract. It's got all the vital stats, the names of the parties involved, the exact dollar amount being borrowed, your interest rate, and exactly how you're going to pay it back. Simply put, this piece of paper is your promise to repay the loan exactly according to those agreed upon terms. Now here is an absolutely crucial exam concept for you. The note literally creates the debt, but, and this is a big but, by itself, it is entirely unsecured. It provides absolutely zero collateral or security for the lender. Yeah, it's a promise, for sure, but at the end of the day, it's just a promise. If a borrower suddenly stops paying, that note alone does not give the lender an automatic claim to the actual physical property. The debt is real, absolutely, but the security? Zero. Section 2. The lender's risk. Financial vulnerability. So what happens if a borrower fails to repay an unsecured note? I mean, this is a massive dilemma for lenders, right? They've just handed over hundreds of thousands of dollars, and all they really have is a piece of paper with a signature. Now, before we explore exactly how the real estate world fixes this massive problem, your verification code is 988771. Anyway, if that promise to repay is broken, the lender is literally left exposed and extremely vulnerable. Sure, they have the legal right to sue the borrower based on the note, but without collateral directly tied to the loan, getting that cash back is incredibly difficult and uncertain. Section 3. The mortgage, securing the promise. And that brings us to the ultimate solution, the mortgage itself. It's defined as a document given by the mortgagor to the mortgagee as security, creating a lien on the property. Let's pause right here because we've got to lock this vocabulary down for test day. The borrower is the mortgagor. The borrower gives the mortgage. The lender is the mortgagee. The lender receives the mortgage. I highly recommend using a little vocal emphasis when you study. The mortgagor is the borrower. The mortgagee is the lender. The borrower hands over this document as security for the repayment of that exact promissory note we just talked about. And once it's recorded in the public records, boom, it formally creates a lien against the real estate. Let's make this really concrete with an example from our text, specifically loan file number 584766. When a lender is reviewing loan file 584766, they aren't just looking at the borrower's promise to pay. Oh no, they are heavily relying on that recorded mortgage to protect their financial interest in the property. By securing the debt with the mortgage, the lender's risk drops dramatically. Why? Because the physical house itself is now the collateral for the loan. If the borrower defaults, that recorded mortgage tied to file 584766 gives the lender the absolute legal right to pursue foreclosure, sell the property, and apply those proceeds directly toward the unpaid balance of the note. Section 4. Hypothecation and concepts. Important legal terms. Okay, here is a word you absolutely need to know. Hypothecation. It's the act of pledging real property as security for a loan. Literally, mentally circle this. Highlight it. Put a huge star next to it. Hypothecation is critical vocabulary for both our course and your state licensing exam. It's really just a fancy way of saying to the lender, hey, I promise to pay you back, and as a guarantee, I am pledging this specific house as collateral. You pledge the property, but the best part? You don't have to give up living in it while you pay it off. Next up is this concept you'll probably hear thrown around, a note of even date. Basically, it simply means that the promissory note and the mortgage were created on the exact same day, as part of the exact same transaction. They're basically twins, born together. And here's the really cool part. When a promissory note is officially backed by a mortgage like this, it graduates. It's no longer just an unsecured promise. it officially becomes what we call a secured note. Let's put these two side by side to really drill home the most important takeaway of this entire explainer. This is the dynamic duo in action. The promissory note creates the promise to repay the debt. The mortgage secures that promise with a lien against the property. One makes the promise, the other secures it. It's that simple. If you can remember this single concept, you've totally mastered the fundamental mechanics of residential financing in a lien theory state. Section 5 Exam Summary. Key takeaways. All right, let's do a rapid-fire review to lock this in for your exam. Here is your perfect checklist of facts. Number 1, the note is the legal evidence of the debt and outlines all your loan terms. Number 2, by itself, the note alone is entirely unsecured. It provides zero collateral. Number 3, the borrower gives the mortgage to the lender as security, and remember that vital pledging process is called hypothecation. Number 4, the recorded mortgage is what actually creates a lien against the property. And finally, number 5, if a default happens, it's the mortgage that gives the lender the ability to initiate foreclosure and satisfy that debt. So, as we wrap up this explainer, I want to leave you with a question to chew on. In a lien theory state, who truly holds the power? Is it the one making the promise or the one holding the lien? It's kind of a fascinating balance of power, isn't it? It dictates exactly how real estate changes hands every single day. The borrower gets the house, but the lender holds the ultimate security. Keep that balance in mind as you dive deeper into real estate law. Keep studying hard, and you are going to absolutely crush your exam.